Thank you, Prem, and a very good evening to all of you friends. It's a real pleasure to be speaking with you, and I thank Cafemutual and Prem for giving me this opportunity to share some thoughts on this very prestigious conference. I do hope that you and your loved ones have been safe in these extremely difficult times. I'm here to speak about the lessons that investors should take away from this period last year's. I think the most important and the most obvious lesson is that while we all run after money, there are things which are extremely important and which unfortunately money cannot buy. So with that, let me now come to what I am really supposed to speak about, and that is what are the investing lessons that this period has taught us. I think there are basically 3 points I would like to make. And the first point is that if you really think of it, and if you think of the key risks that have attached themselves either to life or to capital markets over last 3-4 decades, whatever is our experience, we will agree that the real risks cannot be timed, and we also cannot avoid these risks. And therefore, I think once in a while we should be prepared for being caught unawares for the risk attaching itself either to our lives or to investments. And sometimes even when the risk is apparent, let's say you go back to pre-Lehman times, and I know there were quite a few people who for many years were raising concerns about the rising leverage in US households, about the falling savings rates in US households. But it took a very long time before it finally attached itself. So sometimes even when risks or stress factors are apparent, the timing of that can be extremely hard to figure out. And therefore, at times it becomes very difficult, despite our best efforts, to be able to avoid those risks. So that brings us to the next question. If we cannot foresee, if we cannot avoid the risk, then how do we deal with it? I think again, at least in investing, I think I would like to suggest 2 very simple steps. There is nothing new here. I have been saying the same simple points for many decades. So I don't think whatever I say should take you by surprise or it should be new to you. I think the key to risk management in investing is in asset allocation. And we often ignore that. Quite often we have seen that our asset allocation is a function of our sentiment, of the mood, investing mood. I think that is not correct. Asset allocation should be a function of our emotional and financial tolerance for volatility. As I have said, I don't know, hundreds or thousands of times, each one of us, we need to figure out what is that portion of our wealth, what we can genuinely spare for long periods, on which we can tolerate volatility, both emotionally and financially. And we should invest only that much in a volatile asset class, unpredictable asset class, risky asset class in the short term, like equities. And we should not invest beyond our risk taking capacity. I think if we follow this discipline, it will, at least we are capable of not selling in difficult times, which is a very cardinal mistake in the world of investing, that if you are forced to sell in down markets. So I think if we stick to asset allocation, we can at least avoid selling, or we will not be forced to sell at least in down markets. So I think asset allocation, each one of us speaks about it. And I think what happened last year is once again a very powerful reminder as to how important asset allocation is in the investing journey. I think the second key lesson here is both for institutional investors and direct portfolios, that when bad times come, invariably all equities will fall. The good, the bad, the expensive, the cheap, almost everything will fall. But what we have seen time and again is that the good businesses, the strong businesses that are less impacted in difficult operating environment, and businesses which are reasonably valued, they do not cause permanent damage to wealth. I mean, they will cause temporary damage to wealth, but over time we have seen that you again create value, you again create wealth over time. So I think the second is for equity investors to focus both on sustainability, strength, competitive advantages of a business, and also to focus on value. And we have seen, I mean, at least I have seen that if we focus on buying strong, well-managed businesses and don't overpay for them, despite once in a while extremely difficult environments like what we faced last year, over time, equities outperform bonds significantly, and there is significant wealth creation possible despite events like these. I think now that brings me to the third point is that, so we have talked about, I mean, how we cannot avoid risk and how we deal with risk. And now the third point is how do we take advantage of situations like this, what happened last year. While the situations are extremely tough and the damage what they cause to many cannot be measured in financial terms, but still speaking from a very limited perspective of investing, I think opportunities like, I hate to call it an opportunity, but it is an opportunity in the limited sense of investing what happened last year. And once in a while, we are faced with situations like these. And if you look at when I look back at last 3 decades, every 5-10 years, there has been some event or the other which has led to a sharp correction in the marketplace. Now, how do we take advantage of that? I think this reminds me of the very simple but very powerful line by Warren Buffett, who says that be greedy when others are fearful and be fearful when others are greedy. And I think last year again brings out extremely well that when the whole world was panicking, when the whole world and when majority of investors were driven by the news flow, by the negativity around them, they did not think long term, they did not think optimistically, and they did not focus on value. And that is why many investors either did not invest in equities, and unfortunately many actually reduced exposure to equities, as is pretty evident from the negative flows which mutual funds witnessed for a fairly long period of time. I think that kind of behavior is extremely damaging for long-term wealth creation. It is often said that in 10% of days of our investment horizon, most of the returns are made. So if you do not participate in a move like what happened last year post-COVID, I think it does impact your long-term returns meaningfully. So I would once again reiterate that once in a while we'll be faced with situations like what happened last year, and it is extremely important to focus not on the news flow but the long-term impact of what is happening. Are there reasons to feel optimistic? Will life, will economy, will businesses come back to normalcy? And above all, to focus on what value is being offered, what growth is being implied by the prevailing valuations. And at times like these, I think we should genuinely think few years. We should tell ourselves, I should not worry about what will happen in next 3 months, 6 months, but from this point onwards, over next 3, 5, 10 years, is there scope to make very good returns? And I think if we think like that, if we move away from the daily, COVID count or headlines, I think it will give us a more confidence, more balanced view to approach such situations in the right way. And I think if we act correctly I hate to say this, but once in a while, in a typical lifespan, one can expect 3 to 5 events like this. And if we act right on these events, I think it can make a disproportionate impact to investing, to long-term returns. And that is why I always say that equities are extremely simple asset class, but not easy, because you will appreciate that the message is extremely simple, but acting on it when the crunch comes, in those very difficult moments, is not at all easy. So with this, let me stop here, and I wish you all good health and prosperity in the days to come. And thank you, Prem and Cafemutual, once again.
Prashant, as always, you've made a very lucid presentation. You make out a very convincing case for being in the markets, irrespective of what goes on. But at this moment of time, a lot of us are concerned that there seems to be a huge disconnect between what's happening in the underlying economy and the way the markets are moving. The markets are taking a very overtly optimistic, perhaps discounting good news for the next 2 years. And so, what is your view on this? Aren't they taking an overtly optimistic view of the future?
Prem, I think that's a question which is top of mind for many of us. And even last year, I've answered this number of times. And I think, see, what people focus on is again the news flow, is the environment around them. They look at the shut shops, the markets, they look at the pain all around, and they feel pessimistic. The key is that you need to look at the composition of stock markets. That's point number one. And if you look at the pain has been caused maximum to service-oriented businesses like airlines, malls, multiplexes, restaurants, retailing. But the proportion of these businesses in the listed markets is quite small. So banks have done quite well because the corporate NPA cycle has ended. And that was a far bigger driver of banking profitability last year. Of course, if you look at the credit growth, it is extremely weak due to the prevailing economic environment. But the end of the corporate NPA cycle was a far, far bigger impact on the banks. If you look at software, if you look at pharmaceuticals, if you look at telecom, if you look at consumer-oriented goods, they were not much impacted by the prevailing economic conditions. In fact, IT has benefited. The governments across the world and the central banks have lowered interest rates very sharply, and which is the impact of that which people did not realize in good time. So Warren Buffett said that interest rates act like gravity on stock prices. The low cost of capital has been a massive tailwind for asset prices across the world. And you cannot ignore the impact of significant liquidity and extremely low cost of capital. And I think some of the large businesses have also benefited as they were able to lower costs due to obvious reasons. And also, in some cases, the large businesses have gained share from their unorganized or lesser organized counterparts because of the operating environment. If you look at where are we today, if you look at the 10 and 15-year returns of Nifty even today, it is close to 11% CAGR. Now that is in line with the rupee or the nominal GDP growth of the economy. So I would say these markets are not cheap. They are not very expensive. They are somewhere in the fair value zone. And if, of course, there are pockets which can be pretty expensive. There can be pockets which can offer some more value. But net, I feel these markets are reasonably valued. And if we invest and keep for a 3-5 year view, I don't think we should expect huge returns, but I think we can comfortably expect above interest rate, above cost of capital, above fixed income returns. What is the big risk? I think the big risk is the very low cost of capital, especially in the Western markets. How long will that cost of capital sustain? If that cost of capital goes up beyond what the market is expecting, I think it could lead to some corrections in capital markets across the world.
Okay. Prashant, thank you so much for being with us. As always, you make out a very strong and convincing case for equities.
Thanks, Prem. Thank you, all of you.
And all the best.
Thank you.